I guess, to make money. But more than that, to get good direction on which way the economy's really going. We get so much crap, so many lies, how great the economy is and how great the tech business is, and when it's not. The problem is we have too many people in Washington and in this industry that just don't tell the truth. The truth is everything. And here at Phil's Gang, we stick with the facts. We tell the truth. We make sure our members, are getting the best information, and our listeners, like you. We make that information available to you and make it simple and understandable.
Good investing means understanding how the stock market works. Join today at philsgang.com.
Whoa!
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. I am Phil Grande. Okay, so the market's getting hit again. So what's going on? We talked a little bit about yesterday that all these AI tech stocks, they're getting hit because, as we talked about, starting in April, the big institutions are dumping these stocks. Now, one of the reasons they're dumping all these AI stocks is because they're getting hit with margin calls. And this is interesting. You know how we're always told that, we're always lied to, that the tariffs are not affecting us even though they're 10 to 18%? That is not true at all. I mean, you look this up, not true. Because starting in April, what hit the big institution money, especially the hedge funds, was the industries like tech stocks, consumer goods. Those margins of 10% to 18% brought the values down on those groups. So they own stock in those groups. So the stock prices are going down. So they had to hit, they had these big margin calls. And so, again, hitting the AI stocks, and therefore, again, they with the margin calls, they had a big problem. They had a huge $5 trillion, I think it was like $5 trillion, bam, like in 2 days. So, but let me find where, I think we have a cut where they're saying there's no problems with tariffs. Do you have that one racked up for me?
And people aren't doing their homework to say the stock market declines about tariffs. It's not, because the stocks have declined the most have absolutely nothing to do with tariffs.
What a lie. That's just like the lie yesterday, earnings.
Still optimistic on the market. If we look at, the S&P 500 up 16% so far this year, but earnings are up 13%. I think we've seen more industries participate in that earnings growth.
There's two big lies right there. Just check it out. When you start seeing hedge funds and all these other, the big institutions getting hit with margin calls, it's because the hedge funds are getting hit because that 10 to 18% tariff that we've been told doesn't make any difference is making a huge difference. So you have all of those goods. The value is going down because of the tariffs. That means the stock values are going down, the stocks that these hedge funds and these pension funds that control 70% of the volume, daily volume, they're getting hit. So none of that's true. We're just never told the truth. That is just really unbelievable. So now the other thing they're not talking about too is that starting in December, our quantitative tightening stops. That's bad news. If they're going to bring in QE again, remember they had to bring in tightening, QT, because remember what was going on with the Biden administration? They were spending so much money, to push the stock market up because we were in this election cycle that inflation hit 9%. That's insane. So panic set in to the Biden administration. They're in the middle of an election. How are they going to get elected with a 9% inflation? Now, first they thought, let's keep pushing the market up, the stock market up. We'll do that by increasing the money supply. That's the other thing they did. See, with QE, it's different than QE. QE, a lot of money, QT, tighten. So what they did with QE for the election cycle is made sure they pumped in a lot of money into the banks. What they do is have the Treasury print money for them. And then they go to the banks and say, here, we're going to buy your assets, your mortgage-backed securities, your T-notes, whatever. And we're going to buy those. Now you're chock full of cash. Go loan. But wait a minute, there's a caveat we're going to put on you. Do not loan to small businesses. We don't want you loaning for business investment. What we want you to do is loan for stock buybacks. That's why we are in such trouble with our labor. So those years that they were doing all this QE was not to help the economy. It was to move the stock market up. Now you imagine they took all that money, QE, all that QE money, and they gave it to small businesses, the backbone of our country, the backbone of good jobs, full-time jobs with benefits. Remember, when you have business investment, you go out and buy new machinery, IT stuff. You go out and you new trucks. You build new facilities. You're creating jobs, and then production starts. Instead of producing one table, or let's say instead of producing 5 tables a day, now you can produce 25 tables a day because you upgraded business investment. That means your production increases. When production increases, that means now you got to hire people. Wages go up. People start consuming. The economy grows, but they didn't want any of that. See, this whole country is so myopic on stock market, and the unfortunate thing is very few working folks are in the stock market, other than their 401k, which is worthless, which is a piece of garbage because of all the hidden fees. And because when the market does turn, like a good example, we're in a spot right now, this market could turn any moment. And what are you going to do in your 401k? You're just going to sit there and lose money. That's the terrible thing. Just sit there and lose money. Watch your 401k go down because you don't know how to sell short. They don't allow you to short with a 401k, but at least if you knew how to short, you could go in and you could buy the inverse of the spiders. And so as the stock market's going down, you're making money and you're protecting your 401k. So if you lost $20,000 in your 401k, you make it up on the other side. But the point is that, this QE has really caused the mess that we are in today. We really are. I mean, just think about it. The S&P, if you look at it, the S&P lost in 2 days in April 2nd, April 3rd, about $5 trillion. $5 trillion because of the tariffs. So that's why the hedge funds got hit with margin calls. So again, when you use QE, and again, all QE is you print money and you give it to the banks and you buy assets from them, and they go out and they're supposed to, put the money in the right places, but they don't. They don't. They have specific orders. Same thing going back to 2008 crash. When they increased the money supply there and they went to the banks and gave them money and bought their assets and now all this cash, they said back then, no, don't you help the people who are upside down in their homes. Don't you help small businesses. We want you to go use that money for stock buybacks. And we want you to go, all these banks that have gone bust, we want you to go in and buy those banks. Not the banks, but go in and now they're broke and the banks are going down. Just go buy their cash flow. Buy their cash flow. So QE has been a horrible thing, other than, again, there's a small group of people who made a fortune, just a fortune with QE. Now what's going to happen if they turn around and they said December they're going to stop this QT? Remember, the QT was a good thing because the QT drains all this money out of the financial system. And it keeps it, that's how, you know, when we hear how we dropped inflation from 9% to 3%, remember, 3/4 of that was QT, tightening. It wasn't anything to do with now again, not taking credit away from the administration, they did bring down a lot. They did contribute a lot, but the biggest contributor, again, was to tighten so that when you drain all the money out of the banking, not all of it, you drain all that money out of the banking system, and you know, there's no growth. And so, and that really, now you can't do that continually, okay? You got to, at some point, start spending again. And by the way, the other thing that people do not realize is that since we've had this shutdown, we're spending very, very little money. So if you remember, 2 weeks ago, remember I told you, it was on a Monday, and I said, did you see what happened on Friday? The banks had to go in and get $50 billion because the banks have no liquidity. Now, why don't the banks have any liquidity? See, usually banks at night get together and they loan each other. It got so bad, I think it was October 10th, that Friday. That's when the banks said, we need $50 billion. We can't loan to each other. None of us have any money. Because remember, since 2022, they've been doing QT to drain the money out of the system. So that's caused havoc. So they drained the money out of the system. So now there's no money for the banks. You can't go get a loan. The banks aren't going to loan you any money. So that's why they screamed to the Federal Reserve, hey, we are broke. We need some money. Remember the last time when they couldn't loan to each other overnight? That was 2008. That's when we had the crash. But they learned a good lesson since then. Remember, they weren't going to let that happen again. So now the Fed is the lender of last resort. So they open up their little Fed bank so that these banks can go to them. And then what happens, you get all the big institutions like the pension funds, hedge funds, wealth funds, insurers, especially insurance companies, the large commercial banks, credit unions, they'll put all the money into a pile at the Fed, okay, we'll call it the Fed Reserve, and then all the banks in October 10th went there, they're given all this money, and now they're back out there and they're alive again. But it's just going to be terrible if they go back to QE. If they go back to QE, we're going to go right back again, that they're going to start printing money, more stock buybacks, keep running up the stock market. So it's going to be interesting. Right now, where we're heading, we're going to have, no question, a correction. But I don't think it's going to be here. You usually get one last big rally. Now, why do you get a last big rally before you have a correction? Because remember, the big guys, all your big commercial banks and your insurance companies, remember, they compete for the unions. They want to manage the union's money. They want to manage the New York police, if there's any more police left. New York police. They want to manage the retirement fund of let's say, the union of nurses in Colorado. So they fight for these, and that's big money for them, bringing all that money in, and that's what they do. Now, how do they get them out? As the market goes down, people think, well, they're just going to get them out. So hopefully they get them out before they go broke. That's not how it works. They'll prop up one more big rally. Okay, and then when that rally starts going up, so if you see a rally from here, what happens is it'll go up for a while. Then as they get their clients out and they all made big money, and the problem is the FOMOs are chasing behind them, buying stock like crazy. They don't know what's going on. All of a sudden, the big institutions say, okay, we got the nurses union out. We got the police union out. They all made great. They're up 20%. Now let's pull the bids out. And that's when the markets collapse. That's when the market, I don't think you're going to have a collapse off of what's going on now. And, because, again, they got to get these guys out. But the one thing that's dangerous right now is the fact that the leverage that our financial system has never been leveraged like this. We have $1 trillion borrowed money keeping the stock market up. Can you imagine? I mean, that's insane. We're talking margin debt of $1 trillion. That's crazy. We'll be back with more.
You have 30 seconds.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
You want to invest your money and grow your wealth. How do you invest intelligently? Become a Phil's Gang member and receive the training, advice, and software that will take your investing to the next level. Our team is comprised of successful investors, all with proven track records. Phil's Gang software is easy to use, painless to navigate, and tells you exactly when to buy and sell to help maximize profits. Learn about common market mistakes and how to minimize them. Phil's Gang has successfully taught tens of thousands of investors how to navigate the market with confidence. You don't need to be a seasoned investor to benefit from the Phil's Gang platform, no matter what level of investor you are. Phil's Gang strategies for investing are designed to put you on the path to success. Sign up for a 10-day free trial to see our platform in action, avoid market pitfalls, and start winning with Phil's Gang. Learn more at philsgang.com. That's philsgang.com. Welcome back. Are you ready to make profits in the stock market? Why not check out philsgang.com or give us a call, 877-600-4264. Now, here's Phil.
And people aren't doing their homework to say the stock market declines about tariffs. It's not, because the stocks have declined the most have absolutely nothing to do with tariffs.
Still optimistic on the market. If we look at, the S&P 500 up 16% so far this year, but earnings are up 13%. I think we've seen more industries participate in that earnings growth.
You talk about lies. They just don't tell you the truth. Not to their benefit to tell you the truth. Our earnings, what earnings? What are they talking about? Earnings. First of all, the S&P 500, we talked about this last week, only 10 stocks have earnings. 10. The other 490 don't have earnings. And all these AI tech stocks, the prices now are so high that they're higher than their earnings. That's insane. So that means they're not aligning up with their valuations. That sets off a correction. That's a lie what they're saying. It's just not true. Earnings are not true. We don't have good earnings because what they've done is they pushed the stock price up so high because of the FOMOs that keep coming in, and they go to their margin debt. They don't have any money. They're buying stocks they just can't afford because they don't have the cash. So they're in debt. The leverage right now, most people don't even understand this. The leverage, $1 trillion. Our financial system is supporting $1 trillion to hold the stock market up for the FOMOs, to make sure all these stocks that are being dumped by the institutions, especially by the hedge funds. And again, there's the lies again, as I told you in the beginning. They're dumping stocks because they got margin calls. Not just because they got margin calls, they also are dumping the tech stocks because, as I just told you a moment ago, again, the tech stocks, the prices are so high right now. They're higher than earnings, and the valuations are stretched, they're dumping. But the people who tell you, well, don't worry about the fact that we have 10% to 18% tariffs, that's not doing anything. It's not hurting the economy at all. What a lie that is. That's why they got a big margin call. Think about this. The big margin call they got is because of the 10 to 18% tariffs. Those tariffs destroyed the values of their assets. So if they owned, let's say they owned, I don't know, I'll just make it up. Let's just say they owned Hawaiian orange juice. And all of a sudden the tariffs, the company, they have to pay 10 to 18%. Now the earnings are down 20%. That means the hedge funds that own that company, their valuations went down. Now they're upside down. Now they get a call, margin call, just like a retail customer does, just like a FOMO does. Just like a FOMO does. So that's all a bunch of nonsense. So again, the only defense you have right now I'm saying, I believe you're going to have one more big rally. And as I told my gang today, I showed them, I said, if you go look at, for example, let's take the MAGs, M-A-G-S. If you look at the MAGs of October 10th, and you see when it dropped that day from a high of 65 down to a low of, was around, I think the low was around 61, 62. Look how long it took to get back to that high. It took 1, 2, 3, 4, 5, 6, almost 7, 8 trading days. When's the last time you ever saw a stock, the ETF MAGs, take that long to get back? Here's a better one. Take NVIDIA. Every time NVIDIA would go down, it come right back up. People go in and buying a dip, right? NVIDIA. Everybody wanted NVIDIA, right? That thing would go up so fast. It was incredible. Why? Because who was buying it? The FOMOs. They're scared to death they're going to miss out, right? So now take a look at this. When's the last time you saw that when this stock dropped from, let me just put it out here, when this stock dropped from October 10th to the low of October 22nd, look how long it took to go back up and get back to its high on October 10th. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 2 weeks. When was the last time you saw it take 2 weeks when NVIDIA sold off to get back to where it sold off from? No, because you had the FOMOs in there buying on margin because they have no money. But now look what we're seeing. And that's what you got to watch. That's what you got to keep your eye on now. And I told my gang that. I said, look, you got to watch these key stocks. I said, especially watch ARKK, because that's the one that's going to tell you that margin debts, they're really in trouble. Remember, it's always margin debt that takes the stock market down. Every crash starts with the margin debt, because that's where the panic comes in. And when people tell you, oh my God, you see the market, what a surprise. Anybody that says they were surprised by either a stock going down or the stock market crashing, they shouldn't be in the market. Stock markets just don't go down. They just don't go down. There's patterns. So again, when you start seeing these, like right now, like you look at ARK, which is a great stock to monitor to see if the market's going to have a correction. Look at this. That has dropped from October 8th, a high of 92.65, today to around 80.24. When was the last time you see it would take that long to get back up to its high again? So that's what you got to watch. And today it just broke. We're short that stock. We just started to short that stock today, that ETF today. Just started to short it. Not a lot. We didn't put a lot of positions on, but we just started it. And there'll probably be a snapback where it goes up maybe to around 92 or 82, maybe 84, and then it'll collapse. And it'll take out today's low again, and then it'll go down nicely. But you got to watch ARK. You got to watch MAGs. You got to watch your NVIDIA. And one more that nobody ever watches. I watch it like a hawk. IWM, the small mid-cap stocks. Because the small mid-cap stocks are the most important group. It's the heart and the blood of our economy. In other words, that's where the jobs are. That's where the good, full-time, high-paying jobs with benefits are. And when you start seeing the small mid-cap stock group, these 1,940 publicly traded companies starting to tank, starting to go down, that is telling you there's big trouble ahead. Then you go look at MAGs and see how they're doing. I'm sorry, ARK. See how they're doing. And if they're going down with IWM, that's bad news. Then throw in the MAGs. And if all three are going down, it's warning you we're heading for a crash. The margin account is the cherry on top of that sundae I'm building for you, the margin account. So when the consequences, okay, of such a leverage financial system sitting on $1 trillion of borrowed money is insane. That will trigger a chain reaction of selling like you never saw before. So watch, as I said, that those stocks, those groups, those ETFs, then you will not be surprised. And then start shorting. Learn how to short. It is so bad that people don't know how to short. The reason so many people, 90% of people lose money in the market, 90% in the last 50 years, 90%, because they don't know how to short. And they follow too many stocks. Every stock is a hot stock. And don't forget the other thing. We get lied to every day. We're lied by Washington. They lie to us. Wall Street lies to us. So what do? It doesn't matter if they lie to you if you follow the money. See, that's the whole thing. I remember in 1998 when I built my Pro 2 color-coded chart, I was so frustrated. I'm going, why can't they build a chart that just follows the money so that we know, okay, that if money is going into this particular stock or coming out of this particular stock for a good given time, it will tell us what the stock is going to do, and it'll tell us what the stock market's going to do. And nobody had a chart like that. We did. We built it. 225,000 people have used that chart because it's a great tool to have, because you can see money going in. You can see money coming out. Or you can see if it's just neutral. The charts everyone uses, the generic charts, don't show you that. Now, if you go back and take a look at the, go back to what, April 2nd and April 3rd, I think it was $5 trillion was lost. Especially the hedge funds got hit the hardest. The hedge funds, they got hit hard, and they got slammed with margin calls. And as they said, when you get hit with margin calls, that is really tough. I mean, that's really hard. Panic sets in, and that's what sets off big corrections. It's unbelievable. But we are now at a point, remember this, I'm telling you this, we are at a point, this is one of the most aggressive leverage buildups, that 1.13 trillion. We've never had such a leverage, aggressive buildup since the 1990s. People, I could sit here all day and people won't understand what I'm talking about. All they'll do is go listen to Kramer today, say, I got a hot stock for you. They write down the name, and then they buy it on Monday. It's crazy. It's crazy. But watch, the important thing is going forward. We end QT tightening, which was important to do. We would never got down to from 9% to 3%. We never got there without the tightening. And now with all that tightening, there's no money for the banks. So the Fed finally, we're not going to have a 2008, because finally the Fed, unlike back then, is the lender of last resort. And the money, I don't understand why the government can't pay the people at the airports. And I don't understand that, because we got almost $1 trillion in our checking account, because they're not spending. They're not paying anything. The government's closed. So they got, I looked it up today, they have nearly $1 trillion. Why can't they use that trillion to pay the people at the airport? What do you call them? The tower, what do you call them? Air traffic control. Yeah, air traffic control. There's $1 trillion there. There's $1 trillion. And that money, remember, it's our checking account.
Yep, 2 minutes.
No one can touch it. Matter of fact, the Fed holds on to the checking account, so nobody can touch it. I don't understand that either. So, again, just remember that if they go from QT to QE, there's going to be a big panic set in. But there will be, before that, a large rally. That rally, you're going to sell into it as it goes up, and then prepare to start selling short. Start selling short. If we're still upside down with these kind of margin, this kind of margin debt, most people have never been through a crash with a margin. This margin debt is higher than any other in our history. I can't imagine what kind of crash this would be if there is one. All right, so again, the only way you can make money in the stock market, follow the money, stay with about 6 stocks throughout the year, know how to go long to buy, and then you know how to go sell short. There's only 6 patterns you need to know to follow the money. Just 6. That's it. And if you know those 6 patterns, stay with that same stock through the year, because you know how to go long and you know how to sell short. So you can't, the reason nobody can stay with 6 stocks, because they don't know how to short. They don't want to learn how to short. They're told if you short, if you learn how to sell short or you start selling short, you're going to lose your firstborn. It's crazy. They put fear in you. It's the only way you can survive a stock market, if you know how to do the other side of it. All right? Have a great weekend. See you.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me.